You don't need 20% down anymore. There's a lot of options out there, and you can even get into a home with no money down if you're using local grant programs.
That was awesome. And that was a lot of information. So let's talk about the local grant program just real quick. What's the catch? And we're live. Hey, MOMnation, it's Katie. I am back with another Live and Learn, and I have the wonderful, the fantastic, the highly intelligent Ryan Gilliam with Waterstone Mortgage on with me today. Woohoo!
What an introduction, Katie. Thank you so much. And thank you, MOMnation, for having me today. Looking forward to chatting.
Yes, you are so welcome. I love chatting with you because I always learn something, even after being in this business for, as many years as I have. I'm not even going to date myself here. I still learned something new from you, Ryan. So I love this. Thank you for being with us.
Thank you. Yeah, in this industry, you learn something new every day, don't you? Really, you kind of have to keep up.
Exactly. Well, you're in the same boat. I think you and I have been in the industry about the same amount of time, right? So you're about 15 years too?
We have. Yeah. Gosh, about 2004 is around the time I got in and got trained and everything. So around the same time. Yes.
Yes.
And you got in the mortgage industry as well. That's how you got started.
Yeah. So that's kind of interesting, which is another reason why I love this connection that you and I have, because I speak your language. Because I actually started out. So really quick. Okay. Real quick history, everybody. So left high school, went to college, was going to go to college to become an attorney. And I had to put myself through college because, no millionaire's son. What's that song?
Yep.
And so I was putting myself through college, started working at a bank, got into underwriting. So I got into mortgages, and then that was back east. I came out here with that experience, began originating mortgages as soon as my feet hit the soil, which was 2004, kind of interesting. And then in 2007, I got my real estate license. So that's kind of how the transition went. But I love that background because it helps me. I have a lot of colleagues that don't understand mortgage, and they've been in the business for a while and they don't get it. They don't get underwriting, how it works. They don't get credit, all of that stuff. And so I feel really fortunate having that background because you and I can kind of speak the same language,
It's very important to have that. Yeah, I talk to a lot of real estate agents that completely leave any education about mortgages off the table and leave that to me. But you're really, every time that you set something up for me, you dig in deep and you ask the right questions, and you know exactly what you're looking for because you have that prior education. So I think in our positions, it's really important, like for me to really know the real estate side and to you to know the mortgage side, and you're very well versed on that.
Absolutely. Thank you, Ryan. Tell me I'm wonderful some more.
We'll just keep this going.
Yeah, right. No, seriously though, it does make a huge difference. I got to know a little bit about what you do. You got to know a little bit about what I do. And it just makes it more cohesive and a lot more smooth for our clients, which is another reason why I love working with you. So let us hop right into it, Ryan, with Waterstone Mortgage. You have some things you want to talk about today. So you go ahead and do that.
Absolutely. I mean, first off, the number one question we typically get in the mortgage industry is what's going on with interest rates. Mm-hmm. So that's the first thing I wanted to discuss. And really what we're starting to see is upward pressure on interest rates. And there's two reasons for this. The first reason is inflation. Inflation right now is at very high levels, and that is not good for mortgage rates. When inflation is high, mortgage rates typically go along with that. And on top of that, the Federal Reserve in March of 2020, when COVID first hit, they made the decision to keep interest rates low, to keep the economy going, to keep people, borrowing money. And that really is a big part of the boom that we've had in the real estate industry and why we've seen home prices jump up so much over the past 2 years is because that happened and rates have been so low. Unfortunately, that's part of the reason that we're having inflation. And that's part of the reason why the Federal Reserve is starting to take their foot off the gas a little bit and let rates increase to really hedge off the inflation that we're starting to see. So that's how they combat, inflation going up. So unfortunately, because of that, we are going to start seeing rising interest rates. We were averaging this year maybe in the high twos, like a 2.875. Right now, we're in the low threes, which still historically is very good. Very good interest rate. I know my mom always tells me when we first moved here in 1983, rates were at 18%, So she's like, oh, they're at 3.25. That's still very, very good. But a lot of the industry experts out there are projecting that rates might go maybe in the mid to high threes by the end of the year. But there's a lot of variables. With the new variants that popped up, the interest rates actually did see a little bit of a dip because of that, because the stock market had a sell off. And sometimes when you see the stock market go down, interest rates go down with it. But it's kind of, we're seeing a little bit of a rally back in the stock market right now, because the variant, they are saying that the vaccines are actually showing that they're blocking the variant, which is great. And on top of that, they are showing that it's milder symptoms than maybe the Delta variant, for instance. So really, when we see little news tidbits like that, those are things that could kind of throw things off as we see the upward trajectory of interest rates. We might see little dips along the way, like we did the last couple of weeks with the variant that popped up. So it's really unpredictable. But when you kind of look at everything in a long-term scale, we do see by the end of the year rates being in the mid to high threes.
And you mean the end of 2022?
22, yes.
Yeah.
Yes, sorry.
Awesome. No, that's okay. I just wanted to make sure everybody was on board with that, on the same page as us. So why should our moms be interested in interest rates? Why do they care? Isn't it more about home prices?
Oh, it's about both, obviously. Yeah. Interest rates are going to make a huge impact on your mortgage payment, along with purchase prices. I'm sure that you've seen. I mean, we kind of talked about this recently, how much prices have gone up over the past 2 years. And just the Phoenix area, it's gone up 30% over the past 12 months. We were ranked #1 out of the entire country. And do you know how much the appreciation's been over the past 12 months nationwide? I think it was averaging maybe about 7% or so.
Yeah. Yep.
Yep. So, when it comes to mortgage rates, it really is going to make a pretty big difference. And we could run some calculations to kind of give an idea of how much of a difference it is. But typically, when you see like a quarter of an increase in interest rates, what we typically see with that, like a $300,000 purchase price, or even 350 kind of average here in Phoenix Metro, it could impact your payment by about $50 to $100 when we see that much of an increase. So interest rates are obviously a big, important part of the equation as well.
Yeah, it's giant when you're looking at affordability and when you're focused on that mortgage payment, right? There were some graphics that we had floating around over the last couple of months that actually showed, even if prices came down, which we're not going to see more than likely, at least this year anyway. But even if prices came down and interest rates went up like a point and a half, that actually, in this particular graphic, I'll dig it out and throw it in the show notes, but that particular graphic is showing that the payment is higher for the lower price property with the higher interest rate.
It is, yeah. The interest rates have a bigger impact on your payment than rising prices. That's correct.
Yeah, it's really, really interesting. So mamas, it's important to pay attention to both of those things. Interest rates are just as important. So make sure that you're keeping tabs on that. So we've got some moms out there, Ryan, that I've talked to over the years that have struggled with credit score. Like maybe they went through college and, didn't know and got the credit card and ran that up and did all the stuff that us fun college kids do when we're that age. And now they're in their late 20s, early 30s, wanting to jump into the housing market, but they're realizing they've got some credit challenges. So do you have some tips and tricks for us of what to do if you find yourself in that position?
Absolutely. There's a lot of things you could do to get a jump in your interest or your credit scores. So the first thing that we typically ask people to do is to do a credit check, and we could do that free of charge here at Waterstone, because a lot of people, they're going on maybe Experian directly or Credit Karma, and those credit service providers really aren't as reliable because they use different scoring methods, different algorithms to calculate your scores than mortgage banks do. So I always recommend going to a mortgage bank and making sure you actually get a tri-merge credit check, which is all 3 credit bureaus, Experian, Equifax, and TransUnion, and getting an accurate idea of where your scores are at. So once you get that, the first thing that you could do to really get a quick jump in your credit scores are paying down debts like credit cards, because a big portion of your credit, not just missed payments, which those are hard to fix, but is really the debt to income or debt to high credit limit ratio that you currently have. So if you have a credit card, for instance, that has a $2,000 high credit limit, and you maybe charge it up to about $1,900, that's going to really impact your score. So we always recommend you pay that down to maybe 30% of what the high credit limit is, or even down lower than that. Typically, a magic number, which is kind of funny, is if you pay it down to $10, it keeps the credit card active, but it shows that you have a lot of credit available that you're not using. And you'll see a big jump in your score when you do that. So paying off credit cards or paying them down is really the first thing that we recommend. Another thing that we typically ask for is, when it comes to lower credit scores, a lot of the reasons why we see people that have scores maybe in the 500 range are collection accounts that pop up. Maybe something like an old credit card that got charged off or is in a collection, or maybe even like a T-Mobile bill, or something with your cell phone. Those could pop up. And we also see medical collections. Those pop up a lot. And a lot of the times our clients have no idea how they got there. When there's a hospital visit, sometimes you get multiple bills, sometimes they don't get to you, and they just pop on your credit. So we try to help our clients with that. So what we try to do is something called a pay for deletion. And what you want to do is contact the collection company. First of all, make sure it's legitimate. It's a legitimate bill. And if it is, we always ask to try to settle with those collection companies. Maybe, if they're trying to collect $500, they'll take maybe $250, for instance, just to clear it off. But don't really pay it off unless they actually say that they'll give you a deletion letter confirming that they'll remove it off your credit if it's paid. That's very important, because sometimes if you just pay a collection and they don't delete it, but they just show it as paid on your credit report, it's still going to show, and it's still going to negatively impact your score. It can even drop it a little bit when you pay it. So we don't recommend you pay those off unless you could get a deletion letter, which a lot of our clients have had success with, especially with medical collections. That's going to give you a huge jump in your score, because it's like those collection accounts never happened. So those are two things: paying down credit cards, removing collection accounts. If there were late payments in the past, there are opportunities to possibly get those removed. The one thing you could actually do is what's called a goodwill late removal letter. And it's really just a typical letter that you write to the creditor just saying why there was a late payment. And this really helps if you've typically paid on time. If you've had the account open for a year or two or three, maybe just had one random late payment, just one thing was missed. Maybe you're on vacation, maybe the holidays were crazy, and whoops, I forgot to make the payment. If you actually ask them like, hey, I'm a longtime client, this was a mistake, this was why it was a mistake, would you please remove this late? They're sometimes willing to do that. And that could really jump your score if we remove like a 30-day late. So that's another thing that we look into. Fourth, establishing new positive credit. We've had some clients who've had lower scores because they've had some negative credit in the past, but they've been afraid to take out new credit. That's the last thing you want to do. What you want to do is you want to try to have a newer history of positive credit. And then basically the older credit is just going to kind of fall off, and they're going to focus more on your recent positive credit, which will jump your score. So we typically ask our clients to try to open up a secure credit card, because sometimes it could be hard to get a credit card with lower credit scores. But when it's secured, you're basically putting money down. Like they'll ask maybe a $2,000 deposit up front, and then they'll actually give you a $2,000 high credit limit on your credit card. And once you've actually made payments and you're paying on time, they'll give you that refund back, that deposit. But that's why it's secured, because it's backed by the deposit that you give. So regardless of your credit score, that you can typically get a credit card. So we typically ask our clients, to try to open up one or two of those cards to establish some positive credit, and, charging gas on one, groceries on the other, something like that, and then paying it off each month so you don't have to pay that interest bill as well, and start establishing that positive credit again.
Makes sense. Now, there's some schools of thought out there that I've heard, some chatter online, whatnot, and just, throughout my network, where it's been suggested to pay off all debt. Do you suggest that when you're wanting to prepare yourself to purchase a home, or what's your take on that?
It's okay to pay off all debt. Of course, qualifying for a home, we look at your debt to income ratios. So if there's a lot of outstanding debt, car payments, student loans, that could really impact the size of house that you qualify for. So, in a way, it's good advice, but you have to be careful as well, because if you pay everything off, it's not going to show open and active credit. It's just going to show that you don't really have credit anymore, and that can negatively impact your score. So as I kind of mentioned with that secure credit card, we want you to charge it a little bit each month and pay it off to keep your credit active. So the credit bureaus know that you're out there making payments, and continuing to give you a high credit score. So if you do pay everything off, we still advise you to open and keep open a couple credit cards to continuing to establish that positive credit.
Good advice. It just makes things easier when you
Yeah.
go to get approved, a lot easier. Awesome. So again, social media chatter throughout my network, throughout our clientele, hearing that some people are sort of feeling the pinch with trying to come up with down payment, especially since prices are going up and they haven't stopped doing that yet. And so what is your advice on that?
On the property values going up?
Well, no, I'm finding down payment. Sorry.
Oh, down payment. Yes.
Yeah,
yes.
yeah.
For the down payment for it. So yeah, there's something called like a down payment misconception. I think it was passed down from our grandparents that we always thought, I thought this growing up, that you need 20% down to buy a home. And that's just not true anymore. There's low down payment programs out there. For one, if you're a first time home buyer and you want to qualify for a conventional loan, you can get into a home with as little as 3% down. And that 3% could be gifted from family members. It could be from, a tax refund, anything like that. FHA is 3.5% down. But best of all, if you're a veteran, there's a zero down program. It's the best program out there because you don't have to pay monthly mortgage insurance with a VA loan as well. So if you served in the military, they take great care of you, give you the best interest rates, zero down, and no monthly mortgage insurance. Another program out there is USDA. Now, it's not as popular here, I know, Katie, in our area because, our area is sprawled so much and there's not many rural areas anymore, but we're licensed in 48 states, every state except for New York and Hawaii. And in other areas, there are rural spots. And those areas that are deemed as rural areas by USDA, there's a zero down program for those areas as well. And very little mortgage insurance. FHA is about 0.85%. Is how much they charge per year, broken down monthly. And that's only 0.3% actually is all they charge for USDA. Wow. So that's a great program as well. But there's a lot of local grant programs as well. If you're just looking to qualify, for instance, for an FHA loan, that's all you qualify for, and you don't have that 3.5% down, there's a lot of local bond programs out there. You typically need at least a 640 credit score, but what it is the county giving you money to help with your down payment for first-time home buyers. You don't even have to be a first-time home buyer as long as you're occupying the home as a primary residence. They'll give it to you. I know here locally in Arizona, we have something called the Home in 5 loan that gives you 5% to cover your down payment and some of the closing costs as well. So I know it's a national audience that we're talking to. There's a lot of programs out there in most counties. You just got to know who to talk to find it. And I'm always happy to chat with you and find the right resources. At Waterstone, personally here, a portfolio program that we have that this is unique just to us, we have something called a wealth builder program. And it's pretty exciting. It's we could go up to $750,000 loan amount with zero down.
Wow.
And so there's more and more programs like these coming out. Now the program, it's really for people who want to build equity in their house faster. The reason it's called a wealth builder, it's a 20-year term instead of 30-year term. So the payment's going to be a little bit higher, but we have a lot of professionals that are wanting to pay more anyways, and they're okay with that. They just don't have the down payment saved. So we have that program available as well. And we even have a program for doctors and nurses where it's only 5% down up to $850,000. So I know I kind of gave you guys a lot of ideas of the programs out there, but the long story short, you don't need 20% down anymore. There's a lot of options out there, and you can even get into a home with no money down if you're using local grant programs.
That was awesome. And that was a lot of information. So let's talk about the local grant program just real quick. What's the catch?
The catch. So most programs, I'm glad you brought that up. The interest rate is always going to be a little bit higher if you're doing the grant programs. For us locally, the Home Plus program, the interest rate could be around 1% higher than what you could get if you put your own money down. So we always want to exhaust, you coming in with your own down payment first and foremost, maybe getting a gift from family if possible to keep your rate and payment down. But if you can't do that, if there's no other option, but you want to get into a home while rates are still low and, before prices continue to increase, it's a great thing to look at because what you could do typically is refinance down the road once your period is over. Because here in Arizona, there's a 3-year period where if you sell the home or refinance, you do have to owe some of the grant money back. But once you wait that 3-year period, you could always refinance and lower your rate down to the market. I know we don't know where they'll be in the next 3 years, but that's probably the one drawback for those programs is you always have to pay a higher interest rate to get the grant.
Mm-hmm. Makes sense. I mean, there's got to be something, right?
Yep.
I don't remember the days when people just walked around handing out money for free. So I don't think those are coming anytime soon. What is coming up, lastly, that is going to help out our home buyers that are purchasing, with conventional financing, because they're kind of feeling the pinch with these, especially here in the Phoenix area,
Yes.
with these prices increasing. So what's happening with that?
Yeah, with prices increasing, the conforming loan limits and FHA loan limits have increased with it. So right now, the limits actually have increased to $647,600 for conventional, and that's actually starting right now. So that's great, and that used to be 417,000 was the max, and that was the max for a very long time. But since 2016, it's slowly been increasing as prices increased. And the FHA limit has actually gone up to $356,000, which is an increase of about $85,000. So pretty exciting stuff.
It is exciting stuff. So tell our listeners real quick why that's beneficial and why they don't want to be in jumbo range or non-conforming.
So the jumbo ranges, when you're actually going higher than these amounts, the 647,600, and I apologize, FHA is 441,600. I mentioned the old amount, which we're $85,000 more than right now, which is 362. So it's a big jump for FHA. This is the biggest one that we've ever seen. Mm-hmm. But so really it's great because the jumbo programs, they typically require a higher down payment and they have a lot more restrictions in terms of credit scores. You have to have maybe over 700 or a 740, whereas FHA, which now you can go up to the 441, you could actually get it qualified for as little as a 580 credit score. So that's why it's such a big deal that these amounts have moved up. Mm-hmm. And when you're doing a jumbo loan as well, you have to have typically a lot of reserves. Sometimes you need 6 months of your mortgage payment in your account, maybe up to 12 at times. And that could be hard for first-time home buyers to have that much extra saved at this time, especially when you're putting a large down payment. So, and interest rates as well are typically better when you're going conventional, FHA, VA, USDA, because those are actually backed by the government as well. So that's the benefit of actually going with these programs. So it's big news, it kind of shows you how much property values have increased, that they've jumped up these amounts so much.
Yeah, it is big news. And thank you for bringing this wonderful news to our mamas here. I know that there are some out there that have been just dying to hear this information. I know it because I see them talking about it all day, every day. So Ryan, thank you so much for being with us today. If our mamas want to get in touch with you, how can they do that? What's the best way?
You can just call me directly anytime. I'm always available, weekends, nights. I know in this industry, it's when you find a house you really like, sometimes you got to move quick. And I always want to be here and being available for you when you need me. So my direct office line is 480-635-3035. Awesome.
And I can attest, Ryan does work after hours, weekends. We actually joke on the team that Ryan's a robot and not a real human. So Ryan doesn't sleep, but it's been awesome working with you, and I appreciate it so much. I know our clients do too. Thank you so much for being with us today.
Thanks for having me, Katie. Thanks, MOMnation.
All right, MOMnation. Bye.
Bye, everyone.